Abhay Agarwal, Managing Director at Piper Serica Advisors. Abhay, good morning and welcome to the show. And this is Hiral on this side. Abhay, we were just listening to the conversation that my colleague Sajid had with BlackRock. And their key stance that they're picking up right now is that maintain a neutral on India over the next 6 to 12 months. However, India is in a bright spot from a longer term perspective, and they see greater than benchmark weights for large cap India equity. How would you read into this?
I think it's a very positive sign, Hiral, and I'm not surprised, frankly, because I think when we also talk to some of the large asset allocators, everybody has India on the top of their list for allocation. And uh, uh, I think there is realization that India is, despite its size, its potential, is still a $5 trillion market cap. And if you compare that to China, which is about 18 trillion, US, which is about 60 trillion, you start seeing a medium to long term opportunity. And I think that's what the BlackRock gentleman was alluding to, saying that you need to look beyond the near term issues, near term challenges, and believe that there is a very solid medium to long term story that will outperform. And the reality also is that as we grow, we will need foreign capital because the domestic capital will not be enough to support the growth that we are seeking. So I think it's a good mix of the large allocators, large foreign allocators, optimism about India opportunity and the potential of Indian market to outperform other global markets, and also what we need as a country in terms of foreign capital to support our growth. So I think overall positive, I think if we get this constant flow of foreign capital, which is long-term capital plus domestic capital, which keeps coming into the market, I think this will support the growth that we are seeking as a country.
Abhay, good morning. Alex here. I'm just wondering where that flow comes through, because there have been instances over the past couple of weeks where you had 8,000 crore on one particular day of net buying by foreign institutions, and you couldn't really make out. Usually you can, where you see the bank index or you see a few stocks in the banking pack move quite substantially, which have traditionally been favored by foreign institutions, but you couldn't tell the next day where the deployment took place. So is it the traditional banks and IT and more banks than IT, or is it going beyond that now, considering the kind of float that is available even on the broader end?
So, Alex, I would split that flow into two parts. One is the typical ETF kind of flow that tracks indices and that finds its place in ETFs or stocks that are part of the index. And then there is a part which is more active, that is seeking opportunities, making differentiated bets. So that would not necessarily go into index heavyweights, and that would go into companies that are promising to be next multi-baggers. I would split this flow not on a daily basis, but overall basis. 75%, let's say, is ETF driven, and 25% is active. The 25% active, you do not immediately know, but you start seeing a pattern emerge over 2-3 months as companies announce their shareholdings, and you see which company the FPI shareholding has gone up. I think on a daily basis, Alex, it's difficult to pinpoint exactly where the money is going. But I think if you watch it for a quarter, that's when a pattern emerges. What I'm seeing right now is that there is a judicious mix. There are people having conversation about which are the emerging sectors in India, which will take the leadership and create higher market cap and increase their weight in the index, compared to what we call the traditional defensive bets like IT or that kind. Banks and pharma, I think this time is there is a lot of conversation about banks and pharma because they are in the large cap side seen as growth drivers.
Abhay, my question is, yes, on the sectors, but known for probably capitalizing on the market fear Are you doing that currently? And if so, how much percentage are you holding in terms of cash position? And which are the sectors where you're increasing your positions?
Yeah, Hiral, so as active equity investors, when we get money from our investors, it is part of their equity allocation. So we typically refrain from taking cash calls on that. We just assume that this is the money that they would want to be invested in high quality stocks, high quality portfolio at all points of time, because they would have taken cash calls on the rest of their portfolio. So with that mandate, we typically do not have more than 10% cash in the portfolio at any point of time. We seek opportunities where we see that something has, been mispriced by the market, high growth stock that has corrected, that excites us. So we typically do not take cash calls at this point of time. I think our cash holding would be between 6 to 10%. In terms of sectors that we are overweight on, we are overweight on EMS. Again, but not by recommendations, but we have pretty much all the top stocks like Dixon, Amber, Sirma, Keynes in our portfolio, in our model portfolio. And then the second sector that we are not getting overweight, but adding to the portfolio, which we did not have for a long period of time, is banks, and especially small banks and NBFCs. This is a bit of a contra call because there is still a lot of negativity around this sector. But what we see with RBI support, government support, and greater liquidity in the system, the banks are kind of getting back on their feet. And microfinance is a bad word right now because it's a cyclical bottom. But again, we believe that at this bottom of the cycle is when you need to take some risk and make these bets on the faster growing financial services, financial lenders. So these are the two sectors that we are, if you can say, bullish on. And the third continues to be pharma, which has been an overweight for us for last couple of years.
Okay, I'll get to pharma in a bit, but Abhay, if you can, and I'm not asking you, of course, to give a recommendation here, but just because we're speaking on a morning where the Bajaj twins are getting beaten down, and Bajaj Finance in particular, because of the outlook that they have given, and you spoke about fast-growing financial companies and lenders at that, seemingly a bit of a pivot by this company to say that it is going to go a little slow on unsecured, and that is going to have implications for its ROE, for its ROA, and for the growth that it has in play. What would your reaction to something like that be?
So again, Alex, let's split that whole sector into two parts. There are very large lenders like Bajaj Finance, and then you have HDFC Group, including HDB Financial Services, and then you have a couple of other large lenders. And these are companies that are trading at valuation, simplistically seen as multiples to their book value, which are at a level that they cannot have a quarterly miss or negative commentary. So I think a lot of their stock price correction is driven by the fact that they are market darlings and they trade at a high multiple. Again, great franchises, so it's a matter of time that they recover. Our focus is more on the smaller lenders, and these are the lenders that got more beaten down by the markets because of poor results last quarter, and the current quarter is slightly better, not that there, but the commentary is positive. So what I think last quarter, if you went through every lender's commentary, everybody said that we will cut down on unsecured and focus more on secured, constant commentary, and which makes you wonder that are all lenders, part of a herd mentality that everybody gets out of unsecured at the bottom of the cycle, and when the cycle picks up, everybody gets into unsecured lending because that's where the highest NIMs are. So I will not be surprised if this commentary changes again as the unsecured lending picks up. The government has already provided credit guarantee. The money is flowing in for microfinance lenders against their guarantee schemes. We have seen that money come in for some of the banks and microfinance companies. There is nudge from the RBI to banks to lend to NBFCs and to microfinance companies because they don't want the credit to dry at that level, because these are self-employed people. You need to make sure that they have enough liquidity. RBI has put strong guardrails there, from 5 lenders to 3 lenders as of April 1. So I think a lot of things have changed in the system, and the impact of that will be felt over next 6 months. So I think rather than wait for that to emerge, we believe that it is a good time to start betting on these smaller lenders who have higher allocation to unsecured lending in their books.
Right. So that's an interesting take on that front. Abhay, sectors that are overvalued, let's look at those aspects as well. Would you make any exits at this current point in time? Because even Indian markets substantially are still overvalued. Probably there is some bit of room for correction as well. But if someone has to reallocate their portfolio, exit the overvalued sectors and make new bets, which other sectors would you advise that should be exited?
So Hiral, I would look at, and the way we look at it is that we compare the sectoral valuation and the company valuations to the potential growth. So, and when we do that analysis, we are very objective, and there are no holy cows for us there. So I think one sector that we have been completely underweight in and have zero exposure to for last 2 years is IT services. Now, IT services companies have seen a stock price correction, but I don't think it is still enough, because if a company is guiding for a 0 to 2%, 0 to 3% growth, with margins under pressure, with the competitiveness of the business under pressure, lack of innovation, then I still don't understand that why would anybody look at them as defensive bets and pay a 20 to 25 P multiple for a company that itself is saying that it will not grow at more than 2-3%. So I think the whole IT services pack, just because of historical reasons that it has been a money spinner, is something that trades at a very high valuation than it should. And I think markets will realize that as the earnings commentary, growth commentary stays cautious for the next couple of years. So that is one sector. The second sector is this whole large cap FMCG companies. Again, same problem. At regional level, we are seeing emergence of competition from local brands, and the larger companies have still bit of that arrogant style that we are so strong that we will be able to control our market share and grow. But that is not playing out. So you see some of the large companies struggling for volume growth, struggling for price increases. And trading at multiples which are 40 to 60 times P multiples for these low growth companies. So I think these two sectors, though they may seem defensive, are not investor friendly, because even if you have them in the portfolio, I don't think any return will be made for next 2 years.
So IT and FMCG, point well made, Abhay. I do want to circle back on to what you were saying on pharma, and to widen that also into the healthcare space, because I think now there is so much to talk about in that space, so much that is happening domestically as well. But would I be right in assuming that you're focused on domestic players in the pharmaceutical space, given the kind of uncertainty you have globally, or would you look through that, as some people are saying they're doing, because it's not so easy to shift supply chains?
So we have a mix, Alex. So we have a hospital company for like 10 years in our model portfolio, which is Apollo Hospital, done well for us. And we see that as a proxy for India healthcare in terms of hospitals, diagnostics, pharmacy, the entire integrated play. Then we have large generic exporters and CDMO, so Divi's and Dr. Reddy's fit in there. We believe that that is where there is a significant shift from the US regulator and the US importers looking at India more favorably. And also, the Indian generic companies have also cleaned up their act over the last 5 years. They are more US FDA compliant. Their pipeline is the strongest ever. Pipeline of new product launches in the US is strongest ever that I have seen. Some of them have 150 launches coming up over the next 1 year. So I think as these things play out in a very favorable market environment, where China will definitely not fully go away, but whatever else comes in, even a part of that is very big for Indian companies. So I think it's a very positive environment that Indian pharma exporters are. And Divi, especially because of the CDMO presence, I think that will continue to become a bigger and bigger business and will have higher margins also. So that is the second part of our healthcare bet. And the third part is this whole focus by the government on making sure that spurious drugs in India are weeded out by regulating very heavily the manufacturing of domestic pharmaceuticals. So earlier, because of tax breaks, a lot of small plants came up all over the country. But now that is being consolidated by the government, and there are three listed players, and we have two of them in our portfolio. So there, the bet is that this will be like an outsourced manufacturing for Indian consumption. Indian brands by large brand manufacturers, and that will grow and that will generate higher profits for these domestic CDMO players. So I think that's the integrated healthcare play that we have in our portfolio.